That December jobs report is less than 2 hours away. Joining us now for what to expect, Jack Caffrey, equity portfolio manager at JPMorgan Asset Management, and Michael Gapen, chief U.S. economist at Bank of America Global Research. Good to see you here, both gentlemen. Michael, you're expecting about 175,000 net new jobs. That's roughly in consensus. Is that now, I guess, the new run rate? Do we have this equilibrium in the labor market where this is what we should expect for now?
I think we should expect employment growth to slow further, right? So the 3-month average coming out of December was about 204,000. It was 221 in September, 321 a year ago. So I think directionally we should expect further cooling. So I don't think we've quite hit the point where employment growth has stabilized. I think we should expect it to slow further.
And are we, is the top spinning slowly here enough that we have to worry about it falling over in terms of getting toward a stall in job growth?
Possibly, right? Most of the job gains have been coming from leisure and hospitality and education and health, right? The last of the so-called catch-up sectors. But in terms of private sector employment growth outside of those, over the last 6 months, we've lost about 48,000 jobs. So I think the concern would be when the catch-up effect fades, when does that happen? And, when it does, are we basically at zero employment growth, or will kind of jobs start coming back in the remainder of the economy and be strong enough in leisure and hospitality and education and health to keep us at a more sustainable run rate? That's the open question.
Zero growth at like 3.7% unemployment is a funny spot to be.
Yes, it's an odd spot to be, right? And maybe a Fed more concerned at sticking the landing and having a slightly more balanced reaction function, as the minutes indicated, would react to that more quickly. But I think that is the open question. Where do we settle in when this catch-up effect fades?
Jack, since at least the November CPI report, like November 13th or something like that, we really got further confirmation. People got more confidence that disinflation was really in train. It seems like that released investors to view good news as good news for the economy. Is that still the case? Are we still making sure we want to see that the economy is resilient here?
I think that we have a little bit of creative tension on a cross-asset perspective where the equity market wants good news. I think they need good news in order to justify the prospect of double-digit earnings growth. I think the bond market wants to lean into inflation remains transitory and that we are going to get to a softer landing. And I don't want to accuse my fixed income colleagues of always wanting to look to the dark side, but I think they still remain a little bit more biased towards the downside as possible, and the downside is good news for them. And so that, I think, looking to drive earnings, you almost need something miraculous, because fading inflation takes away pricing pressure for the corporate sector. Wages are sticky-ish. And if you go back and think about, over the weekend, I watched a regularly running commercial. 256 people will get drafted into the NFL, but there are 400,000 trades jobs open to be hired. There was an ad for hiring to build submarines. I've never seen that before in my 58 years of life. So you have this need for employment, which we haven't seen, and we've actually lost jobs in. And that makes me think wages remain sticky-ish unless companies start firing in order to maintain profitability. If that's the case, then you're not getting the growth that drives earnings. So how do we get this operating leverage without we need operating leverage with a slow economy, without pricing, and where you've got some sticky costs.
All of this, though, is sort of an old discussion in the sense that we're now toying with this idea that there's not a whole lot of connection between either job growth, wage growth, or economic growth and inflation. We have seen, and Mike, I mentioned your thoughts on this, the economy remains strong and resilient. And inflation come down from 10% to 3%. So there's a lot of on Twitter and the Twitterati when it comes to the economy, saying, you know what, maybe this thing is completely disconnected.
Yeah, I think that there's probably still, a lot of the distortions from the COVID cycle are still getting wrung out of the system, which may be kind of masking what's happening underneath. But we haven't been in a situation in decades where we've come off of massive supply constraints like we are. So whether it's global supply chains or in the domestic labor market, right? It was only 12 to 18 months ago we were talking about massive labor market shortages, early retirement effects that won't go away. And it's been the surge in participation that's unlocked, I think, the ability of the domestic economy to grow faster while still giving us inflation. So it's been a lower inflation. Yeah. So it's given us a much different mix than we're used to dealing with say, normal demand, the cyclical demand story, right? It's to me, it's been this supply story overlying it that's made it unusual.
Jack, if you characterize the implicit desires of equity investors, at least, as a miracle, it would seem like that's not one you think that you would bet heavily on.
Well, I think companies spent 20 years being very good at managing their cost structures. Yeah. And if we go back and think, I'm a child of the 80s and early 90s. We talked about rolling recessions. I think if we do look within the equity market, we might have had a version of a rolling recession where in late 2022, there was pressure on companies that were perceiving themselves as secular growth. It was growth almost, if you will, with profitless prosperity. I'm going to grow quickly, but I don't need to be profitable. And then suddenly something changed in a world of inflation that I need you to make money. Those companies were aggressive at cutting costs and turning that into restructuring charges, which turned into margin expansion in 1Q, added some boost from the hope for lower inflation. Those stocks took off. They led our market last year. Can we see some rotation underneath the surface of companies saying, I'm getting slower and I'm going to start firing some people, but hopefully not to the point that you actually start infecting consumer sentiment, that the consumer really retrenches and so effectively forces a slowdown rather than strategically or surgically managing your way to profitability on a cost basis. To drive that miracle.
Muddle through is an option. I also always point out the magical mid-90s soft landing also had serial corporate restructuring the entire time. I mean, it was, in retrospect, it's like, you don't think about it.
The mid-90s also was the real problem that the Fed caused happened out of the United States. And the derivatives market. So, Mexico going bad, let's create some treasury programs and let's cut aggressively. The U.S. itself wasn't really touched as much by that.
No, it's not perfect. It's just the point is you can always point to,
we pulled
winners
it off
and
of the
losers.
problems of somebody else's.
Yeah, exactly.